Canada's annual inflation rate unexpectedly eased to 1.9% in November. It's the second time in 3 months that the increase in the CPI dropped below the Bank of Canada's target. Let's get more from Jimmy Jean, VP and Chief Economist at Desjardins. Jimmy, thanks very much indeed for joining us. Your impression of this inflation number, does it leave the door open for more interest rate cuts, for example?
I think it still leaves the door open. I mean, we have inflation slightly below the Bank of Canada's target. For sure, I think there was a little bit of attention to the Bank of Canada's preferred core measures. Those ones perked up a little bit, but part of it is technical and due more to the mortgage interest cost component. Sort of no longer being excluded from the CPI trim component. So it's more technical in nature rather than anything fundamental. If anything, I think the story's been about generous discounts on the part of retailers on Black Friday, and this is a kind of disinflation story I think the Bank of Canada wants to see. It does suggest that we're in an environment where retailers feel that consumers do need that kind of discount and support in order to spend, and therefore pricing power might not be very high.
So your take right now is that we'll get a cut of 25 basis points in January, but that the Bank of Canada might hold off in March?
That's right. I think with the latest move that they made, a 50 basis points, which could still be argued what wasn't necessarily warranted, but they wanted to speed up the process to get into the neutral range. Now that they are, I think they can take their time. So I think there is still scope for that additional rate cut. I mean, the support for rate cuts remains well in place. We have not just the risk from trade, but we have the slowdown in immigration, and also the mortgage renewal wall. We've talked about this extensively, but it hasn't really lost in relevance. So for those reasons, the Bank of Canada wants to ease things, but it's now in a place where it can do so very gradually. So that's why we think about one cut a quarter will be what's going to make sense in 2025.
The government, in terms, if we could move on to the fiscal update yesterday. So we got this big $60 billion plus deficit for the year past, the last fiscal year. But they say we do expect to maintain this declining debt to GDP ratio and keep deficits below 1% of GDP. However, there was an upward revision in nominal GDP, so that makes that task a bit easier.
It does, certainly. There's been, it's not the first time we see that. There's not the first time we see upward revisions to GDP. When we were dealing with high inflation, that was boosting nominal GDP. But there tends to be a habit of, immediately spending back those windfalls. And certainly yesterday was no exception. So they still had those numbers showing a decline in, deficit to GDP. But it would have been much better looking were it not for the additional spending per se. Now, the nuance is that the type of spending that they unveiled, save maybe for the GST, but the measures to really boost investment, I think those are the types of investments of government interventions that we have long believed should have been prioritized over the last few years. So now they're coming a little bit late because we're grappling with the uncertainty related to trade. But this is exactly the kind of measure that should have been deployed much earlier, and maybe we'd be in a very different place when it comes to investment and when it comes to productivity in this country.
I referred earlier to Claude Lavoie. He wrote this op-ed in the Globe and Mail. He's a former Director General of Economic Studies in the Finance Department. He uses this expression, and I think you use it too, that Canada is among the cleanest dirty shirts when it comes to, among governments, when it comes to debts and deficit.
That's right. And we keep saying that every budget or every fiscal update. We wish that there would be a better sense of control on expenditures in terms of generating savings. We haven't quite seen that from this government. But the efforts to clean up in the past in prior governments and over the past few decades have been so successful, so important that despite those shortcomings that we see budget after budget or update after update, we're still relatively speaking in good shape at the federal level. Now, of course, you don't want to take that for granted because we know how painful it is to get to that place. I'm not sharing the view that this is, despite all the drama yesterday, I think what we actually saw was not that catastrophic. Having said that, there's a big cloud of uncertainty that relates to the tariffs. And if we were to see a situation where 25% tariffs are applied, certainly the growth numbers that are behind those estimates would have to be revised much lower. So there's still some decent downside risk to those estimates.
What is your view? Finally, Jimmy, give us your view on the Canadian dollar. We saw it dipping below 70 cents US. It's hit the lowest today since early 2020, and when COVID was really cranking up, actually. Do you think we're going to see more weakness in our currency?
Well, for most of the year, the Canadian dollar depreciation story has been really the story about the U.S. dollar rallying against just every currency. Now, starting in mid-September, we start to see the U.S. dollar rallying more as a function of expectations that Trump would win the White House with his tariff agenda, and the country of the currency of the country that wants to implement tariffs. It's logical that the currency would tend to appreciate. So that's been part of the story. But indeed, what we've seen since last week is a Canadian dollar that's underperforming against all currencies. So it's no longer the U.S. dollar story. It's really what's happening here in Canada. And I think that bout of political uncertainty, which I think is temporary. I mean, at one point, things will get resolved. And really the worst that can happen is that we get an election sooner than expected. But for now, it's pushing the CAD lower. I think we're just likely to see just more volatility while things get settled on the political front.